Chapter 7 covers accounting for receivables. In this first video lecture, our primary focus will be on accounts receivable. There are several different types of receivable. The most common and significant are accounts receivable and notes receivable. There is a category of other receivables for things like income tax receivable, amounts owed by employees, those sorts of things. So with accounts receivable, we know that an account receivable results from a sale on credit or a sale on account. In our ledger, we'll have an accounts receivable. This account is what is known as a control account, and then we would have a subsidiary ledger in which we would keep track of the individual customer accounts. So an entry that you're familiar with would be an entry to record a $100 credit sale on account. In this case, we're going to debit accounts receivable and credit service revenue for $100. So we're increasing an asset and increasing equity by the same amount. In some situations, instead of extending credit directly to customers, most businesses will use third-party bank cards such as Visa, Amex, MasterCard, Discover, and so on. In these situations, the seller pays a fee to the third party and debits it to credit card expense. The amount reduces their net sales. Typically, these fees are 1 to 5%. So if we're going to record an entry to record a $100 sale on a bank card with a 4% fee, 4% of 100 is $4. That's going to be our credit card expense. That's going to reduce the amount of cash that we receive. So 100 minus 4 is a debit to cash for $96, a debit to credit card expense for 4, and a credit to sales revenue for 100. Companies extend credit to customers in order to increase sales. Some customers will not pay, and this results in bad debts expense. We're going to see that bad debts expense is considered an expense of the sale and needs to be recorded in the same period of the sales revenue in most cases. There are two different ways to account for bad debts. There are the direct write-off method and the allowance method. The direct write-off method is not allowed according to GAAP in most situations. A company can only use the direct write-off method if it doesn't have very many receivables or bad debts. If a company uses the direct write-off method, the loss is going to be recorded when the debt is determined to be uncollectible. Most companies, to comply with GAAP, have to use the allowance method. And with the allowance method, the loss or the bad debt expense is estimated and recorded in the same period of the sales revenue. Under the direct write-off method, an account is written off to bad debts expense directly at the point it is determined to be uncollectible. Say, for example, the customer declares bankruptcy and we don't think it's worth it to stand in line and see if we get 30 cents on the dollar. So this company is going to go ahead and write off that bad debt. They're going to debit bad debt expense at that time and credit accounts receivable to take it off the books. The issue with this is that it does not match expenses with revenue. So for example, the revenue might have been recorded in 2021 and the account is written off to bad debt expense in 2022. So we don't have a matching of expenses with revenue. Therefore, according to GAAP, this is acceptable only when bad debts are not significant or it approximates the results of the allowance method. So most companies are going to use the allowance method because it matches the estimated bad debt expense against revenue in the period of the sale. It requires that we estimate bad debts expense. The other advantage is that it reports accounts receivable at net realizable value or cash realizable value. In other words, the amount of cash that we actually expect to collect. Under the allowance method, bad debts expense is recorded at the end of the accounting period in an adjusting entry with a debit to bad debts expense and a credit to allowance for doubtful accounts. So allowance for doubtful accounts is a new account for us, and it is a contra asset account. It's a contra asset to accounts receivable. Accounts receivable has a normal debit balance. The contra account is going to have a normal credit balance. And when an account has a normal credit balance, it means it's increased by credits and decreased by debits. Wonder Company had an accounts receivable balance of $10,000 at December 31, 2022, its first period of operations. At the end of the period, it estimates that $500 will be uncollectible. So they're going to make an adjusting entry, debiting bad debts expense and crediting allowance for doubtful accounts for that $500. So we now have an accounts receivable balance that has a debit of $10,000 and allowance for doubtful accounts has a credit of $500. So when we put this information on our financial statements, the bad debts expense is going to get reported as an operating expense on the income statement, and accounts receivable is going to be reported in the current assets section of the balance sheet at net realizable value, which is equal to the balance in accounts receivable minus the balance in allowance for doubtful accounts. The accounts receivable balance is a debit and the allowance for doubtful accounts balance is a credit, so we net those to come down to $9,500 in this situation. So when an account is determined to be uncollectible, it is not written off directly to bad debts expense. Instead, it's written off against the allowance for doubtful accounts. So we have a T account here that shows how the allowance for doubtful accounts works. We credit it for estimated bad debts and we debit it for actual bad debts. So going back to our Wonder example, if Wonder determines that the $300 account of Dante Company is uncollectible, they're going to make the following entry to write off the account under the allowance method. We're going to debit the allowance for doubtful accounts and credit accounts receivable to take the account off the books. So looking at our allowance for doubtful accounts now, we estimated bad debts of $500. We put that in the account as basically a reserve against which to write off accounts, and then we have an actual bad debt of $300 that gets debited to the account. In some cases, a customer will come back and pay after their account has been written off, and in that case we have a recovery of a bad debt. So after Dante's account was written off, payment in full was received by Wonder. So first we need to make an entry to record reinstatement of the receivable, and that means we're going to bring the receivable back onto the books. So essentially what we're doing here is reversing that entry we made to write it off. So here we're debiting accounts receivable and crediting allowance for doubtful accounts for $300. And then we would make the same kind of entry we would always make to record collection of an account, a debit to cash and a credit to accounts receivable. So in terms of estimating the amount of bad debts, there are two different ways to do this. One is known as the percent of sales method. The other one is known as the percent of receivables method. So if we're using the allowance method, we know that we're going to need to estimate bad debts at the end of the period. One way, percent of sales method, is also known as the income statement method. And in this method, the bad debts is estimated as a percentage of credit sales. So you'll be given the percent of credit sales, you multiply it times credit sales, and that's going to give you your estimate of bad debts expense. The other way to do it is slightly more complicated. It's known as the percent of receivables method or the balance sheet method. And in this case, bad debts is estimated as a percentage of receivables. So we're going to take the percent of receivables, multiply it times the balance in accounts receivable. That doesn't give you bad debts expense, it gives you the desired balance in allowance for doubtful accounts. So we have Harlem Company with net credit sales of $150,000 during the current period, and they estimate that 1% will be uncollectible. So their estimate of bad debts expense is 1% times 150,000 or $1,500. So in this case, the $1,500 is the bad debt expense, and we just have to debit bad debt expense, credit allowance for doubtful accounts for the $1,500. In terms of estimating using the percentage of receivables basis, we're going to go back to our Wonder Company example and say at the end of 2023, Wonder had a balance in accounts receivable of $20,000 and a balance in allowance for doubtful accounts of $100. So the balance in accounts receivable is a debit balance and the balance in allowance for doubtful accounts is a credit balance. So we're estimating 5% of accounts receivable, or 5% of $20,000 equals $1,000. That is not the bad debt expense. Instead, that's the balance that we want to have in allowance for doubtful accounts. So we currently have a $100 credit balance in the account. We want a $1,000 credit balance. So the difference between those two numbers, or the $900, is the current period bad debt expense. So we're going to make a debit to bad debt expense and a credit to allowance for doubtful accounts.